Hello everyone, and welcome back to another episode of Simply Wall Street's Market Insights. My name's Michael, and this week we'll be discussing why copper's long-term prospects look favourable. One of the reasons for the recent market volatility was the rising odds of a recession in the US. Copper, also known as Dr. Copper, is often regarded as a leading indicator for the global economy because it is used in so many industries. Interestingly, the copper price peaked in May and has fallen as much as 22% since then. In the short term, it appears that copper supply is overwhelming demand, and that may be a warning sign for the global economy. But the longer-term picture is very different, with a potential supply deficit on the horizon. If that's the case, the current weakness may be offering investors an opportunity. This week, we're taking a look at the outlook for copper producers and how to gain exposure if you agree with this narrative. Before we dive in though, here's our quote of the week. I have an eccentric view on commodities, not necessarily shared by my colleagues or by almost anybody else, and that is, we are running out of everything. Jeremy Grantham. Now, let's dive into what happened in markets this week. Here's a quick summary of what's been going on. Firstly, from IBD, Disney unveils plan to invest $60 billion in expansion of theme parks and cruise line. What's our take on this news? Disney plans to invest $60 billion in its experience segment over the next 10 years. The investments will include several new cruise ships, new theme parks, and new rides. These investments make sense as this segment currently accounts for half of Disney's revenue and most of its operating income. In the long term, these investments should create value for shareholders. In the medium term, investors are going to have an interesting time valuing the company. When Disney launched the streaming service in 2020, the PE ratio shot up as the share suddenly became a growing tech stock rather than a mature media company. Now though, just as the streaming business has become profitable, cash flows and margins are going to come under pressure from another part of the business. Investors might be in for a free roller coaster ride as the market figures out the right multiple. Next up, from the Financial Times, European investor sentiment falls the most in 2 years. What's our take on this? When optimism drops, opportunities arise. The ZEW indicator of economic sentiment fell 25 points, its biggest drop since April 2020. This has been attributed to uncertainty around interest rates, 2 wars in the region, and slowing growth. Some see this as an opportunity. Morgan Stanley's European equity strategist said their market sentiment indicator, MSI, is now indicating a buy signal. This isn't really surprising. Weak sentiment creates opportunities for patient investors. Next up from Techopedia, Huawei is set to rival Nvidia with new AI chip amid US sanctions. What's our take on this news? New rules require new approaches. Since banning the export of high-performance AI chips from the US to China in 2022, companies like Huawei have had to start making their own. In October, it plans to launch a chip called the Ascend 910C that reportedly rivals Nvidia's H100. The development isn't without hurdles though, since the chips are experiencing production delays and Huawei is facing the prospect of further US restrictions. The smuggling of Nvidia chips into China has reportedly become rampant. Even US companies are trying to find creative workarounds to the restrictions. Nvidia is working on a custom chip tentatively named B20 to comply with the export restrictions. The restrictions introduced in 2022 lowered Nvidia's market share in China from 90% to 17%. If tensions between the US and China remain elevated, new restrictions may be introduced as both countries want to be in the lead when it comes to AI advancements. Next up, from Sherwood, Universal Music Group and Meta expand their partnership as labels lean on social media. What's our take on this news? The music labels need the social platforms more than the platforms need the labels. It's one thing to have a catalog of valuable music, but it's another thing entirely to actually distribute it and help listeners discover new music. So, why not partner up with platforms that have huge amounts of engaged users? That's exactly what the labels have done. Meta and Universal Music Group have had a relationship since 2017, and according to Universal executives, this renewed multi-year contract, quote, expands money-making opportunities, addresses issues with artist royalties, and aims to curb unauthorized AI-generated content. Both Universal Music Group and Warner Music Group have shown how reliant they are on these types of channels. Universal's music streaming revenue in Q2 suffered during a TikTok blackout, and Warner said it would lose up to $10 million per quarter after Meta removed its premium video catalog. Next up, from CNBC, Starbucks stock jumps 24% on news of CEO replacement. What's our take on this news? One man's pain is another man's gain. After only 16 months in the CEO role at Starbucks, Laxman Narasimhan is being replaced by Brian Niccol, the CEO of Chipotle. Starbucks has declined 20% under Laxman's leadership, excluding Tuesday's meteoric $20 billion gain. Meanwhile, Chipotle has climbed 773% since 2018 under Brian's leadership. It should be noted that Laxman didn't have prior restaurant experience, while Brian had plenty from Pizza Hut and Taco Bell. Activist investors in Starbucks like Elliott Management and Starboard Value are in full support of Brian, as well as Starbucks' founder, Howard Schultz. Brian Niccol reportedly said, "I know what to do," when he was contacted by a board member about potentially taking the CEO role. Change takes time, especially for big companies. So while the current CEO was only given 16 months, any new CEO should be given at least a year to implement some meaningful changes with results. And lastly, from Axios, nuclear is having a moment as investment skyrockets in 2024. What's our take on this news? Power-hungry data centers, the fragility in the energy market, and nuclear's political revival are all contributing to more investment in this energy source, according to Axios. Investment in advanced nuclear fission technology has jumped tenfold from $355 million in 2023 to $3.9 billion in just the first 7 months of 2024. The funding is coming mostly from venture capital funds, private equity, and billionaires like Sam Altman, Jeff Bezos, and Bill Gates. Tech companies could play a role in funding development and progress as they form partnerships to meet the needs of their AI-focused data centers. As for the political side, it appears nuclear energy is the one thing that Democrats and Republicans can agree on, well, for now at least. Axios said the Department of Energy's nuclear research and commercialization programs consistently get big funding and bipartisan support in annual appropriation bills. So, while nuclear power is not without its challenges, it is receiving increased investment and recognition as a viable energy source for the future. Now, let's dive into the main piece. Copper, the precarious balance between supply and demand. By volume, copper is the third most used industrial metal in the world, behind iron ore and aluminium. About 75% of that goes towards making electrical wires, telecommunication cables, and electronics. For more than 100 years, it's been a key resource for several industries, and its use cases continue to grow. As the chart below illustrates, the price is prone to extreme volatility due to all the different dynamics affecting its supply and demand. So let's start with the demand side. Demand continues its steady rise. Copper consumption has increased steadily since before 1900. Until recently, it was primarily used for construction, power, communication, electronics, and manufacturing. Copper is now also an essential input for renewable energy, automation, and the electrification of the economy. Copper demand is therefore driven by rising global prosperity and most of the new growth industries. China consumes about 55% of the world's copper, while the rest of Asia consumes around 15%. This consumption is related to both economic development and manufacturing. The rapid increase in demand and the copper price in the early 2000s was a result of China's infrastructure development. While that investment has slowed, demand from the manufacturing sector has continued to increase. Despite the slowdown in China over the last few years, annual copper imports have remained stable, even at higher prices. However, small changes in inventories and demand can lead to big price moves on a month-to-month basis. Now let's talk about the supply side. New supply may not keep up. Global copper demand is currently about 28 million tons a year and increasing at around 2% a year. This demand is satisfied via a combination of newly mined and refined copper and recycled copper. Current reserves are estimated at around 870 million tons, which should be enough to satisfy demand for over 20 years, except that it's a little more complicated than that. Like any mine, the cost of production depends on the grade and how easy it is to access the copper ore. Some reserves aren't viable unless the copper price is high enough. Similar dynamics apply to recycling. Higher prices mean more recycled copper can be processed. Most of the copper mines being developed currently are actually existing mines that are being redeveloped. S&P Global recently updated its annual analysis of copper discoveries, which showed how few new discoveries have been made in the last 15 years. The large copper producers are choosing to redevelop existing mines rather than exploring and developing new reserves. There are three reasons for this. Firstly, exploration and development of new sites is costly and takes a very long time. S&P estimated that on average it takes over 16 years from discovery to production. This period has increased due to the number of regulatory hurdles that need to be overcome. Secondly, many of the world's copper reserves happen to be in countries prone to political instability or where the risk of nationalization of assets is common. This list includes Zambia, Chile, Peru, and Panama. And thirdly, redeveloping existing assets is cheaper, faster, and comes with less risk and uncertainty. These factors mean producers are reluctant to invest in new sites even when it means margins may be higher. All of this has led economists to forecast a gap between demand and supply for copper concentrate. The reality is that that gap will depend on the copper price. When prices are high enough, new sources will become available. Now let's talk about copper producers. The world's largest producers of copper are Freeport-McMoRan, BHP Group, Codelco, and Anglo American, all of which produced over 1 million tonnes in 2023. Of these companies, Freeport derives most of its revenue from copper, but also produces gold as a byproduct. Codelco in Chile is state-owned, while BHP and Anglo American are diversified miners that earn between 25 and 30% of their revenue from copper. Diversified miners Rio Tinto Group and Glencore also produce copper alongside other commodities. The other large producers which derive most of their revenue from copper are Antofagasta, First Quantum Minerals, KGHM Polska Miedz, Southern Copper, and Teck Resources. The diversified miners spread their exposure across multiple commodities, as well as multiple locations, which is just as important given the political risk. If you are investing in smaller companies, make sure you know where their assets are and what the potential risks are in those countries. There are several copper ETFs, but it's worth noting that most of them have slightly underperformed the copper price over time. The largest is the Global X Copper Miners ETF, which holds 40 shares and caps the weight of each at 4.7%. The United States Copper Index Fund is an ETN that tracks the copper price via the futures market. So, what's the insight here? Investing in junior copper miners is only for those with the risk appetite. If investing in copper ETFs or big diversified miners isn't your thing, or you already own them but you want more exposure, you may want to look at the smaller players. That is, of course, if you're an investor with the risk appetite for them. If you use the Simply Wall Street stock screener to list all the copper mining companies in the world, you'll see there are 100. Of these, most of them have market caps below $1 billion, and quite a few of them are valued at less than $50 million. Small mining companies offer the potential for large upside but also come with numerous risks. When it comes to copper, the really compelling argument for investing in small caps is their potential to be acquired. If the large mining houses don't want to invest in exploration, the next best option is to acquire smaller companies with proven assets. BHP Group recently tried to acquire Anglo American for $49 billion for exactly that reason. That deal fell through, but it's likely that more acquisitions will follow. If you are looking at small cap copper producers, here are a few things to keep in mind. Firstly, valuations are very likely to be inflated when the copper price is rallying. If you're going to find a bargain, it's far more likely to be during a slump in the copper price. Secondly, do your due diligence on the management team. Make sure they have a successful track record with similar assets. Thirdly, find independent assessments of the company's reserves, including grades and likely production costs. Use this information to make a conservative estimate of the value of the assets. Consider the valuation from the perspective of likely acquirers. And lastly, make sure the company has a strong enough balance sheet. Look for those that could survive for at least 3 years before running out of cash and becoming a forced seller. The less debt they have and the more cash they have, the better they can handle downturns in the market. Now let's wrap up with the key events during the next week. After a flood of data over the past 2 weeks, analysts are taking a breather this week. On Tuesday, the Reserve Bank of Australia will release the minutes from the last monetary policy meeting. Also, Canada's inflation rate is forecast to remain at 2.7%. On Wednesday, Japan's trade data will be published. Economists expect the surplus to narrow to $50 billion. The US Fed will publish the minutes from the recent FOMC meeting. On Friday, Japan's inflation rate will be published. It's expected to rise slightly to 2.9%. Earnings season continues with SaaS companies, China's tech companies, and a few retailers reporting, and these include PDD Holdings, Intuit, Lowe's, Palo Alto, Analog Devices, Medtronic, Synopsys, Target, Snowflake, Baidu, and Dollar Tree. That's all for this week's Market Insights. Thank you so much for listening. And until next week, invest well. Simply Wall Street analyst Richard Bowman and Simply Wall Street have no position in any of the companies mentioned. This article is general in nature. We provide commentary based on historical data and analyst forecasts only using an unbiased methodology, and our articles are not intended to be financial advice. It does not constitute a recommendation to buy or sell any stock and does not take into account your objectives or your financial situation. We aim to bring you long-term focused analysis driven by fundamental data. Note that our analysis may not factor in the latest price-sensitive company announcements or qualitative material.